In illustration number 7, on April 1, 2015, following balances appeared in the books of Mrs. Kanishka Traders. Balances given. What is our requirement? Prepare furniture account and provision for depreciation account for the year ending 31st March 2016. We are supposed to prepare for only 1 year, right? So, furniture account and provision for depreciation account. Provision for depreciation account. Is that okay? Year March 31st, 2016 only. On 1st April 2015, following balances appeared in the books of Mrs. Kanishka Traders. Furniture account 50, provision for depreciation on furniture being 22. So already there is a balance. In furniture account, the opening balance on 1st April 15 being, okay, 2 balance brought down, being 50,000. By the same date, we have the provision for depreciation also 1/4/15 by balance brought down. The value being 50,000. 22,000 rupees. 22,000. Okay. Provision for depreciation on furniture. Okay. On October 1, 2015, a part of furniture purchased for rupees 20,000 on April 1, 2011. Okay. Part of furniture on October 1, 2015, a part of furniture which is purchased for rupees 20,000 in April 1, 2011 was sold for rupees 5,000. Sometimes earlier on 1/4/11, an asset purchased for 20, okay, 20 is sold in which date? On 1st October. On 1st October it is sold. Now, what could have been the provision for depreciation for this asset? If the rate of depreciation here being 10% per annum, apply the same rate year after year. For the year 11 and 12, the depreciation being 10% on this, 2,000 rupees. What sort of depreciation? 10% per annum on original cost. So, SLM method of depreciation to be followed. And automatically after this, the value being 18,000 rupees. This is the balance as on 31/3/2012, which is called as WDV, written down value. Written down value is nothing but the value of the asset after the depreciation. Again, for the 12 and 13, we might have provided depreciation for this under the same value, rupees 2,000, as it's the original cost. From the original cost only we have to calculate. Now the WDV being 16,000 rupees on which date? 31/3/13 WDV. Again 13 and 14, depreciation here being 2,000 rupees. Today it's worth rupees 14,000, and this is nothing but WDV on 31/3/14. WDV on that date. And 14 and 15, another 2,000 is subtracted, then this value being 12,000. So the WDV of this asset on 31/3/2015 being 12,000 by this time for this current year. And this asset is going to be sold on which date? 1st October, right? So on 1st October it is going to be sold. So up to the date we have to calculate the depreciation. So up to 1st October 15. So 20,000 rupees is the value of the asset, and rate of depreciation being 10%, and the number of months eligible for depreciation is up to 1st October, 6 months, 6 or 7, 6 months. So into 6/12, then the value being 1,000 rupees. Half year is over. After that, the WDV as on the date of sale being 11,000. WDV as on the date of sale is 11,000, but was sold for how much? Was sold for 5,000 rupees. Okay. Now sale value on the date. Sale value on the date being 5,000 rupees. 11,000 but sold for 5,000. What does it mean? The difference between these two is loss. Loss is how much? 6,000 being the loss. Is that okay? Loss on sale. Loss on sale. Now, how much of accumulated depreciation on this asset as on this date of sale? 9,000 rupees is the accumulated depreciation as on the date of sale. Is that clear? Now, I am going to incorporate all these things in this account. Let's see here. We have to pass the journal entry for this, right? For the current year. We are going to work out for year 2015 and 16. In that year, we have to first pass the entry for what? This depreciation. The entry being depreciation account debit to provision for depreciation. Provision for depreciation. So, on 110.15 by depreciation, the value being 1,000 rupees. The value being 1,000 rupees. Whenever the asset is sold, the accumulated depreciation on the asset sold is transferable from the provision for depreciation to asset account. So here on the same date 110.15 to furniture account. To furniture account, what is the value here? 9,000 rupees. 9,000 rupees is going to be transferable from here to furniture account. So on 110.15 by provision for depreciation, that provision for depreciation is credited in the furniture account as on the date of sale, and it's an accumulated depreciation of the asset sold since the date of purchase to the date of sale, which is 9,000. And today it gave us a revenue of rupees 5,000, cash inflow of 5,000 rupees so by bank or cash. This value here being 5,000 rupees, 5,000 rupees bank. And we face a loss of rupees 6,000, should also be posted here, loss on sale on the same date, 6,000. So we have posted all the three. So whenever there is a sale of an asset, amount collected, and next one will be provision for depreciation model, means any accumulated depreciation on the asset sold will be transferable from the provision to furniture account. Third, is there any profit or loss because of sale? These are the three items you have to keep in your mind. So number one, okay. Number one, accumulated depreciation on the asset sold and the amount collected on sale, and third one will be loss on the sale or profit or loss on the sale. So these are the three important points to be kept in your mind. Is that okay? Now, and on the same date, a new furniture costing 25,000 was purchased on the same date. So 110.15 on the same date, furniture is purchased, bank. The value of new purchased asset being 25,000, and the depreciation was provided at the rate of 10% per annum on original cost of the asset, and no depreciation was charged on the assets in the year of sale. See, this information I have not seen. Which information? The last one. The assets sold, no. For that, the depreciation on the in the year of sale is not provided. In the year of sale is not provided. Okay. Prepare furniture account and all as usual. As per this instruction, you no need to provide the depreciation for the year. Okay, for the year in which the sale happened. If you don't provide the depreciation, then automatically WDV being 12,000 sold for 5,000 rupees. And the difference between these two is loss. And then the accumulated depreciation as it is not there, it is 8,000 rupees. Only small change. Only small change. Here, accumulated depreciation or the provision for depreciation on asset sold transfer being 8,000 rupees because this 1,000 is not provided. You are subtracting 1,000 rupees in the credit side as well as in debit side parallelly. And here this one. And this impact will be in loss on sale of asset. Is that okay? This impact will be automatically in the loss on sale of assets. Either you may show that as a depreciation or anyhow it may get adjusted as loss on sale. In both the way we can work out. The first model what I have solved, no, that's the usual one if nothing stated. But in this illustration clearly stated, in the year of sale for the asset sold, no depreciation is provided. So in that assumption, I don't create any depreciation date. Is that okay? Rest of the things are the same. Now create the depreciation. This is not there. In the year end 31st March 2016, we have to create the depreciation. The depreciation for the one of the assets. Actually, 50,000 rupees worth of assets we have, out of which 20,000 rupees worth of assets sold. So only balance 30,000 rupees worth of assets we have. For that, 10% depreciation will be provided, 3,000. Not only that, we have purchased one new asset for rupees 25,000 for that 10%, but this new asset is purchased only on 1st October. So from the 1st October to 31st March, we have only half year. So this is eligible for half year's depreciation only, right? What is a half year's depreciation here? 1,250. Am I right? So 1,250. So the overall depreciation charged here being 4,250 here. Now if I tally the furniture account, the balance as on the date 31st March 2016 by balance carried on, the value being 55,000 rupees. You can cross verify. How do I get that 55 straight away? Out of 50, 20,000 worth assets sold, so 30 will be there. New asset being 25, so 30 plus 25, definitely there should be 55. Anyhow, you have to cross check. So 75,000 in the debit side and tally this and find out the balance. If I tally and get the balance, you will get the same 55,000 rupees. Is that okay? Yeah, of course it's matching. Anyhow, you have to guess it side by side. Now, when it comes to the provision for depreciation for the year end, okay, 31st March 2016, balance carried on. How much we have the provision for depreciation to be carried further the next year. So here the total being 26,250, 26,250, here 26,250, and if I subtract the 8,000 rupees, the balance being 18,250. 18,250. Okay, rewrite in the opposite side. Is that clear? So illustration number 7 is over. Solve the illustration number 7. If the firm maintains furniture disposal account prepared along with the furniture account and provision for depreciation and furniture account. Okay, the provision for depreciation and furniture account. So if we have the disposal account, furniture disposal account, how the illustration will be? Let's see here. Small adjustments in the same illustration. See, when it is being asset disposal account, asset account will appear at its own original value, and provision for depreciation where we have the accumulated depreciation in it. If the asset is sold, the sold assets original value will be transferable to the asset disposal account. Asset disposal account. Similarly, accumulated depreciation on the asset disposal will also be transferable to the asset disposal account, and then the sales is now passed on in this account. As per the traditional model, this is all about sales, no? This is nothing but summation of this is nothing but original value. In provision for depreciation, usually we will transfer that to the furniture account. No. Here, this will be transferable to, this is nothing but accumulated depreciation on the asset sold. Transferable to asset disposal account. And this original value will also be transferable to asset disposal account. And then the sale is routed through the asset disposal account. That's all. Rest of the things are the same. As usual, normally how you prepare the furniture and provision for depreciation, you just follow the same way. The depreciation, accumulated depreciation on assets sold is transferable from the provision for depreciation account debit to asset disposal account. And then the original value of the asset sold is transferable from the furniture account, that asset account, to asset disposal account. And in asset disposal account, normal sale, like you can pass the entry. Okay, let's see here. Asset account. Asset account of furniture here, right? Furniture account. And then provision for depreciation account, provision for depreciation, and then asset disposal account. Asset disposal account. The opening balance of furniture being to balance 50,000 rupees and new purchases being 25,000. And in furniture's credit side, I just copy here. This one is copied, that's all. So I skip the date here. And this entire value is now grouped, and that value will be transferable to the asset disposal account. So for that, the entry being asset disposal account. Original value of the asset disposed here being 20. And then the balance carried on is as usual 55,000. It got closed. 75,000, 75,000. Okay. And in provision for depreciation, we will start with opening balance. Balance brought down 22,000 rupees. I just copy from here. There will not be any change. And by the year end, we again create the depreciation for the leftover assets, which is 4,250. Summation of these two. And the accumulated depreciation of the asset sold is transferable from the provision for depreciation to asset disposal account. For that, here to asset disposal. Asset disposal. This value being 8,000. I transferred that to asset disposal account. So by provision for depreciation, the value being 8,000. If I tally this, 26,250. 26,250, you will get the balance carried on here. This value being 18,250. This asset is also transferred here, right? So to furniture account. This value being 20. So 20,000 original cost valued furniture sold for some value. For this, we have accumulated depreciation to the extent of 8,000 rupees. Now, at what rate it is sold? The rate of sale here being 5,000 rupees. As usual, bank 5,000. And because of the sale, we faced a loss. Loss on sale 7,000 rupees. If I tally, then automatically it gets closed, right? So in asset disposal account, this entire block will be automatically transferable to the asset disposal account. This breakup will be available only in asset disposal account. This breakup is available in asset disposal account. That's all. So routed through asset disposal account. The purpose of preparing the asset disposal account is to know more detailed information regarding the asset disposed. Right. Come on, finish up copying this. In illustration number 9, what we had to do? Prepare plant account, accumulated depreciation account, and plant disposal account, assuming that the company closes its books on 31st December every year. So calendar year is adapted. So the first purchase happens on January 1, 2012 by Jain & Son. Purchased a second-hand plant. And finally, it is destroyed by fire on July 31st, 2015. It is not sold, but anyhow, as it's lost in fire accident, it might have been insured. That's why this company gets the insurance claim for the loss. So receiving the insurance claim is equated with the sales realization. You assume that the asset is sold and you get the money. No. Same way, when the asset got destroyed, where it was already insured, then any insurance claim is received is equivalent to sale consideration received. So we have to now prepare the accounts since the date of purchase to the date of disposal. And here the asset is passed through, sold or disposed through plant disposal account. So in case of plant disposal, what do you do? Transfer the asset disposed at the original value to the asset disposal account, as well as the accumulated depreciation on the asset sold up to the date of sale should also be transferable. So these two you have to understand. Now, plant account, and provision for depreciation account, Finally, we have to prepare asset disposal or plant disposal account. Is that okay? Now, acquisition happens on 1st January 2012. A second-hand plant. If you purchase any second-hand asset, to bring it to working condition, any expenses you incur like repairs and renewal or any other installation charges, a test run and all will be forming part of the assets value only. Should be accumulated that all the value put together the assets value, right? So here plant costing rupees 2 lakhs and spent rupees 10,000 on its overhauling. It also spent 5,000 rupees on transportation and installation of the plant. So all the three values, the cost of acquisition of the second-hand plant and overhauling expenses 10,000 rupees and transportation and installation 5,000, all the value put together, it comes around 2 lakhs 15,000. This is the value of the asset also. Right. On 1st January 12, plant account debit to what? Bank. The value being 2 lakhs 15,000. Okay. It was depreciated to provide for depreciation at the rate of 20%. That too on written down value method. So we have to adapt written down value method. Under written down value method, every year you are going to calculate the depreciation based on the WDV value. WDV value is nothing but original value minus amount of depreciation already charged. Whatever the leftover amount of the assets after the depreciation will be called as WDV. On that, this 20% will be applicable. The plant was destroyed by fire on 31st July. So up to 2014, we just repeat as usual. So there will not be any change in the value of the plant up to the date of sale because we are going to follow the provision for depreciation. Any depreciation is there will not be adjusted in the plant account. So the plant account remains the same year after year. So the first year end 31/12/12 by what? Balance 2 lakhs 15,000. This becomes as an opening balance the next year 1/1/13 to balance 2 lakhs 15,000. By that year end 13 by balance, by the time also the value is the same 2 lakhs 15,000. Next year 1/1/14 to balance 2 lakhs 15,000. By the year end 31/12/2014 by balance 2 lakhs 15,000. Now from 1/1/15, no, so to balance brought on 2 lakhs 15,000. In this year, halfway through the asset was sold on July 31st, 2015. On sale, the asset at the original value will be transferable from the assets account to asset disposal account. So I will be posting that now. The disposal happens on 31st July 2015 by asset disposal account, AD account in short I use, right, 2 lakhs 15,000. Thereafter, the balance of the plant and machinery will be 0, nothing will appear. This value is transferred to the plant disposal account. The date of transfer being 31/7/15 to plant account. The value being 2 lakhs 15,000. This will be plant disposal account also. And the provision for depreciation In the very first year, we have to create the depreciation. First year end only we will be charging the depreciation. So 31, 12, 12 by depreciation. By depreciation. The rate of depreciation in this case is 20%. So we have to provide the depreciation 20,000, 20% on this. 43,000. Hope so. You could not understand. So it's 43,000. Now if I tally this, you will get the same 43,000 as the balance on the same date. 31, 12, 12. Balance brought down. Okay. To balance brought down 43,000. This becomes the opening one for the next year. 1113. Yeah, any doubts? By balance 43,000. In the second year end 31, 12, 13 depreciation supposed to be provided. I'll just use a working note here. Original value on 1/1/2012 being 2,15,000. As per the WDV model, depreciation for the year 2012, 20% on this being 43,000. After subtracting the value, what you have is nothing but WDV as on 31/12/12. Yeah, come on, tell me the value. 1,72,000. And second year depreciation, the depreciation for the year 2013, 20% on 1,72,000, 34,400. So 34,400. After subtracting the WDV here being 1,37,600. This happens on 31/12/13. Okay. Now we have to provide the depreciation for the next year 2013. This is 12, 13, 2014. No, for the year 2014, 27,520. Yeah. After that, the WDV on 31/12/14 being, yes, 1 lakh minus depreciation should be subtracted. 1,10,080. Now the last year depreciation will be provided up to the date of sale. The date of sale happens on 31/7/15. Half 7 months depreciation to be provided, right? So 1,10,080 into the rate of depreciation being 20%. Now the period for which we supposed to calculate is 7 months only. So into 7/12. What is the ultimate value? 12,000. Okay. 12,843. Am I right? 843. Okay. Now here I'll just post all these things in provision for depreciation. 43 is over. Second year 34,400. If I total this, what is the total depreciation? 77,400. 77,400. On 31/12/13, the balance now being 77,400. Next year 1/1/14, opening balance being 77,400. And for that year end 31/12/14, you have to provide the depreciation, which is 27,520. Already we have found out that in the working note. So 27,520. If I add this, the final value being 1,04,920. 1,04,920. That becomes the balance here. 31/12/14. The balance being 1,04,920. Next period 1/1/15, the balance being 1,04,920. And in this year, halfway through, one of the assets sold. Up to the date of sale, we have to charge the depreciation here. So 31,715. Depreciation here being for the 7 months 12,843. Now if you total this, the total value being 1,17,763. Okay. Now whenever the asset sold, automatically the accumulated depreciation on the asset sold will be transferable to plant disposal account. That asset disposal account 1,17,763. That goes to the plant disposal account in the credit side. So on the same date 31,715, provision for depreciation, this value being 1,17,763. And finally the provision for depreciation is closed. No more provision is required as the asset is already destroyed, and plant is also zero. Now how much compensation we received here? We have received compensation of rupees 50,000. Either it may be received or it may be assumed to be outstanding, but here it is admitted by insurance company. They have accepted to pay, as such now not paid. So then automatically it becomes a due. So insurance claim account debit to plant disposal. Due entry, party's name will come. So I'll use the insurance claim account here. Insurance claim. If we have collected this money, no problem. If we could have collected, then we can directly name this being bank. Here not yet collected. So this value being 50,000. This value being 50,000 rupees. And tally this and find out if there is any profit or loss due to fire accident. Of course, there is a loss. So loss on fire accident. Loss on fire accident. Is that okay? Loss on fire. Balancing figure. So 2,15,000. 2,15,000. The balancing figure here being 47,000. 47,237. 237. Is that okay? Come on, make a note of it. April 1, 2015, a substantial modification was made in the machine to make it more efficient at a cost of rupees 80,000. See, we may have repairs also, repairs and renewal. If it has value addition, okay, it will give extra benefit because of this income, this expenses. Then it should be capitalized. Capitalized means it should be addable with the assets value. No extra, then it will be chargeable to the P&L account, debited to P&L account. If there is any efficiency increase, that will be addable with the assets. So addable with the assets, debit to asset account. No extra benefit, then it is debited to the P&L account. If there is any extra benefit, then it will be addable to the assets value. If I have a car, I do repair expenses. Okay, probably the tire may be worn out, I may replace the tire. It costs us around 20,000 rupees. So to replace the car's tire, it costs us me 20,000 rupees. Because of replacing the car tire, the car will not have any extra efficiency. It will run, that's all. That 20,000 will be then charged to the P&L account. Rather than that, if I convert the petrol driven car into the LPG driven car by fixing the extra tools, so that hereafter I can use the car for, LPG kit. LPG can be used for driving the car. Because of shifting from petrol driven car to LPG driven car, now I am able to save the cost. So there is some extra benefit I am able to enjoy because of shifting from petrol driven car to LPG driven car. That cost us me 50,000 rupees. That will definitely add the cost or benefit for the asset. No, so then it should be capitalized. This will also be addable with the car cost. Is that okay? Same way, in this illustration, on 1st April 2015, 80,000 rupees worth repairs and renewal carried over, but it increases the efficiency. Because of that reason, this 80,000 will be addable with the asset. Is that clear? and this amount is to be depreciated at the rate of 20% on straight line method. This will also be eligible for 20% depreciation under straight line method. So if we are adding with the cost of the asset, means that will also be eligible for depreciation, right? So here in this case, this is also eligible for depreciation. Routine maintenance expenses during the year 13 and 14 being 2000 will have no importance at all. It may be directly debited to the P&L account. Is that okay? Drop the machine account, provision for depreciation account, and charge to the profit and loss account in respect of the accounting year ended 31st March 2016. So we have to prepare only for the year ending 2016 accounting year. It means 2015 and 16 only you have to prepare. Is that okay? So 2015 and 16, I need to prepare only this year. So here we have the asset here, machine account, and provision for depreciation. Clear? This is original cost, right? Original cost model. It will be appearing at its own original cost. Any accumulated depreciation on that will be available in the provision for depreciation. Here, machinery account debit, machine account debit to what? Opening balance. On which date? 1/4/2015. To balance brought down. There will not be any change in the value of the asset, so it remains the same 8 lakhs. It remains the same 8 lakhs. And on sometimes later, we incurred additional expenses. Okay, on 1st April, on the same date, additional expenses also incurred for repairs and a renewal. That will increase the efficiency of the asset, so it will be forming part of the asset's value. And this 2000 can be directly debited to the P&L account. So repair expenses account debit to cash 2000, and later that repair expenses debited to the P&L account. So P&L account debit to repair expense. That's how we can pass the entry. Repairs debit to 2000 to bank. The next entry will be this repair expense is going to be charged to the P&L account. So profit and loss account debit to repairs. Is that okay? Now, there is no any other changes in the machinery account, so you can simply tally this. For the year end 31/3/2016, the value of the machinery being balance brought down, being 8,80,000 rupees. Is that okay? Because depreciation will not be adjusted in this account itself. We have a separate account which is called provision for depreciation. In provision for depreciation, we need to have the one opening value here. So 1/4/2015. Okay. By balance brought down. How much it should be? So the depreciation as on this date should be the accumulated depreciation of the asset exists by the time until that time. Okay. Originally the asset purchased on 1/1/2013. As on this date 1/4/2015. How many years are there? 2 complete years are there. So the accumulated depreciation for this asset could be for 2 years. You can easily calculate that. So the value of assets being 8 lakhs, rate of depreciation being 20%, calculate for the 2 years. The value being 3,20,000 rupees. Am I right? The value being 3,20,000 rupees. Now for the current year end 31/3/2016, depreciation can be provided here. The depreciation could be on total value 8,80,000 rupees. 8.8 lakhs for that 20% will be provided for the current year. This value being 1,76,000. 1,76,000. If I add up this, 4,96,000. 4,96,000. And here, this will be the closing balance. Okay. To balance brought down. See here. What are the things supposed to be prepared here? Machine account, provision for depreciation account, and profit and loss account in respect of the accounting year. So profit and loss account, in that we might have charged the repairs, not only repairs, the depreciation could have been also charged. Right, come on, post this. For the modification which has some effect on efficiency, then it should be capitalized. Capitalized means addable with the assets value. On the same date, an important component of the machine was replaced for rupees 20,000 due to excessive wear and tear. This should usually be debited to the P&L account. Anyhow, in CBSE book, it is given as an addition to the asset, but I recommend this to be debited to the P&L account directly. In CBSE book, they have adapted AS number 6. Now, currently, it is not applicable. So, we have replaced, currently, it is replaced with AS number 10, property, plant, and equipment. So, there only we are going to incorporate all those things. As per that provisions, I doubt that this is not going to be capitalized. Anyhow, I just stand by with the CBSE only. This 70 is also addable with the asset, and this 20 is also addable with the asset. Okay, excessive wear and tear. It has no any efficiency change in the later, means it should not be capitalized. Okay, but here it is capitalized in the text. Routine maintenance should always be charged to where P&L account only. Is that okay? Prepare machinery account, provision for depreciation account, show the working notes accordingly for the year ending 31st March 2018. So we have to prepare only for the year 2017 and 18 alone. You no need to prepare for all. So machine account, and then provision for machine account, provision for depreciation. Okay, provision for depreciation of machine account. And current year starts on 1/4/2017. To balance brought down, the value being 6,80,000. Apart from that, 2 extra expenses incurred in this year to be capitalized. Okay, one is 70, another one is 20. The another 5,000 expenses cannot be capitalized. That should be charged to the P&L account only. So I am capitalizing that these two, 70 and 20. 70 and 20. No more adjustment happens here. Tally this. 7,70,000 rupees. 7,70,000 rupees. So for the year end 31/3/2018, by balance carried on being 7,70,000 rupees. In provision for depreciation, in the year beginning 1/4/2017, there will be accumulated balances of depreciation for the assets possible. So by balance brought down, the value being 6,80,000 rupees, and for that 20% since the date of purchase to this date. How many years are there? Purchase on 2015, 16, 17, 2 years is there. So 2 years depreciation could be there. Okay, 6,80,000 or 680,000 since 20% and 2 years for that. Come on, how much is that? 2,72,000. So 2,72,000 rupees is the value here. And for the year end 31/3/2018, we have to provide the depreciation. By depreciation, the depreciation will be calculated on what? Full value, 7,70,000 rupees into 20% for the full year. We have to provide this. This value being 1,54,000. Am I right? Yeah. You can now tally this. The balance being 4,26,000 here. So as on 31/3/2018, to balance carried on being 4,26,000. 4,26,000. Yes, come on. Make a note of it.